Well, we've been mentioning CN Rail shares have been under pressure today as the trade uncertainty is creating some volatility in the railroad operator's business and its outlook. Our next guest covers the company on Wall Street and has some cautious comments in reaction to the results. Jonathan Chappell is Senior Managing Director of Surface Transportation and Marine Transportation Equities at Evercore ISI. So, Jonathan, I believe you downgraded the shares in response to what the company had to say. How come?
Correct. Yeah. Good morning. So the downgrade was, really, in just bring it back 6 months. In 2024, Canadian National had a lot of issues that were not self-inflicted. There was port strikes on the West Coast. There's port strikes in Montreal. There was a short strike on their own network, both Canadian rails, some extreme weather, the forest fires in Jasper. So 2025 was setting up to be a really good year for them. Volume momentum, you remove a lot of the excess costs that were in 24, real strong margin growth, real strong earnings growth, and they initiated a guide of 10 to 15% earnings growth this year that they reaffirmed in their first quarter results in April. However, they lowered the guide yesterday to mid to high single digits. The volume momentum, to me, is the most concerning part. At early part of June, 9 to 10 weeks into the second quarter, they were tracking at 1% volume growth for the second quarter. They ended down 1%. And 3 weeks into the third quarter, the volume, I shouldn't even call it growth, the contraction has been really noticeable, bottom of the leaderboard across the entire Class 1 rail space. So yes, there's a lot of things, again, that are kind of outside of the control as it relates to tariff uncertainty, macro, softer backdrop. But the difference in Canadian National's volume momentum versus that of all the other Class 1 rails, including its Canadian peer has led us to lower our numbers quite significantly, not just for this year, to within their new guidance range, but also for next year where they removed their 2026 guidance.
All right. So at the end of the day, what do you think that investors need to be keying into given those trends and given the fact that CN just basically said that it's an environment that's so tricky that it is hard to share some more concrete numbers?
Mm-hmm. I would say it's relative volume growth. For better or for worse, the rail industry is very data rich. You get a weekly update on volumes across every single end market that they're involved in. You get a weekly update on service metrics like velocity, dwell, cars online as somewhat of a proxy for productivity. And it's not just the absolute volume numbers. We have to look at it in the scope of how the other rails are doing as well, because they're all facing similar, macro headwinds. So it's really been noteworthy to us, again, over the last 2 months or so, just the magnitude of relative underperformance. If CN starts performing more in line with the rest of the peer group, if you start to see some more productivity improvements, then you may think that the bottom's in on earnings estimate cuts and multiple compression. But until you see that volume reacceleration or moving up the relative leaderboard, it probably still continues to lag.
Okay, Jonathan, one of the other things that we should address for our audience is that there's been quite a rumor mill on Wall Street around whether or not we're going to see more M&A in this sector. I mean, it's already a pretty heavily consolidated group, but you asked a really what I think is an important question, actually, to the CEO of CN on the conference call, because it's not just whether we might see some deals or anything like that, or whether Warren Buffett's Berkshire Hathaway wants to get back into the act, but it's also that these different rail operators do have existing relationships with other freight operators, and I guess that could get a little complicated if all of a sudden, one player's going after another or what have you. Can you just sort of connect the dots for us on that?
Yeah, so let's work backwards here.
Okay.
I mean, to my direct question on the conference call, frankly, there wasn't a very clear answer. So, I asked it not just to have my voice heard, because we really don't know how these collaborations are constructed and if there's any out clauses or what the timing is on them. So, for viewers' background, Canadian National has an agreement with Union Pacific, which is the kind of the head U.S. rail in a lot of these rumors, called the Falcon Express, which is Mexico cross-border north-south trade into the U.S., which arguably shouldn't be that impacted by a transcontinental east-west railroad. There's two bigger concerns, though. First is if the U.S. rails were to consolidate, obviously there would be more of a length of haul advantage there. And given the bypassing of Chicago, where CN already has an advantage, would there be some competitive impact on CN and to a lesser extent CP possible? The other issue is kind of a flow of funds, which is less fundamental and more, stock market related, which is the Eastern rails have been targeted as the likely acquirees. And the Canadian rails, I think, have been seeing some sell-off on both the fundamental impact or potential fundamental impact, I should say, but also just going into, the targets, which is the East Coast rails. We'll see what happens with this rumor mill. There's a lot of smoke. But there's not a lot of fire. I think until that time, the Canadian rails, unfortunately, are probably going to have a little bit more pressure than the U.S.